What actions are you taking given the uncertainty that COVID-19 presents?
Our goal is to stay disciplined to our investment process. The process guides us in buying companies and franchises that can create shareholder value, are managed by competent leaders, have appropriate balance sheets, and that trade at valuations at a discount to our estimate of intrinsic value. As investors try to price the uncertainty that COVID-19 presents, the correction in the stock market has given us an opportunity to add to names on both ends of the spectrum. On the one hand, we've added to our position in Roche, which we consider a quality and defensive name. Roche is a preeminent pharmaceutical company based out of Switzerland with a very strong balance sheet. The figure you see on your screen now shows you Roche's share price history over the last 1 year. We were able to add to our position on March 12th at a price of 274 Swiss francs. In our opinion, the stock could be intrinsically worth in excess of 400 Swiss francs, so we saw this as an opportune moment to add to the name. The correction in the stock market has also given us an opportunity to add to our cyclical names like Renault, a French automobile manufacturer. One way to understand how irrationally the market is pricing a company equity is to ask what is implied in the current market price. The next figure shows you a breakdown of Renault's intrinsic value and compares it to Renault's market value. Essentially, the chart shows you that Renault's market cap is around 5 billion euros, and Renault's stake in Nissan is alone worth close to 6 billion euros. So the market is attaching a discount to that stake. Furthermore, Renault's two divisions, Renault Automobile and Renault Finance, have an adjusted book value of around 7 billion euros. So at these prices, you're essentially getting both of those divisions for free. Overall, you're getting a company that's conservatively worth over 12 billion euros for a price of 5 billion euros. This is a material discount for a company that has no operating debt and is one of the largest automobile manufacturers in the world. This is also visible in the next chart, which shows you the company's price to book history. As you can see, Renault's average or median long-term price to book multiple is around 0.7 times, and it's reached a high of 1 times when the cycle has been in its favor. That compares to a current price to book multiple of 0.3 times, again highlighting the material discount that the company is trading at. While the international pool is positioned for an economic recovery, having exposure to both quality and defensive names like Roche and cyclical names like Renault allows the portfolio to provide some downside protection if the economic recovery is delayed. At the same time, it allows the portfolio to benefit if there's a pickup in economic activity. This also highlights our opinion that neither us nor other market participants have an edge in calling the exact timing of the market recovery.
What are the biggest risks companies face as a result of COVID-19, and how do you manage these risks?
One important risk that could materialize if we have a delayed economic recovery relates to liquidity and the balance sheet side of the equation. Global economic activity has taken a pause in recent weeks, and generally, this means that company revenues are impacted negatively. However, a lot of these companies still have to cover their expenses such as rent or debt repayments or interest or lease payments. Companies that do not have ample liquidity or access to debt capital markets or lines of credit could face a liquidity crunch and even bankruptcy in severe cases. We manage this risk by adhering to our investment process regardless of where we are in the cycle. Our process requires us to invest in companies with appropriate balance sheets. The easiest way to see this is to compare our portfolio's net debt metrics with that of the benchmark. In the next chart, you can see that the pool has a net debt to equity ratio of approximately 36%, and that compares to 44% for the benchmark. This means that on average, our companies have less leverage and therefore they have more room to navigate a delayed economic recovery environment.
What companies are navigating this environment well?
At a company level, we would like to highlight two companies. The first one, Tenaris, is a company that operates in the energy services sector and makes pipes for oil drilling. Although the company's stock has suffered with the rest of the sector, the company's strong balance sheet in a net cash position and its ability to swiftly manage costs in a downturn should allow it to survive a prolonged downturn. However, we cannot say the same about its closest competitor, Valurec. This is visible in the next two charts. The first chart here shows you Tenaris' free cash flow under different oil price scenarios, or more specifically, its free cash flow to sales ratio. As you can see, Tenaris is free cash flow positive or at worst neutral under most oil price scenarios. However, its competitor Valurec is not. The second chart highlights Tenaris' balance sheet under different oil price scenarios, or its net debt to EBITDA ratio. And as you can see, Tenaris' balance sheet has the strength to withstand even the most dire oil price scenarios. However, Valurec is underwater under different scenarios. This highlights the strength of Tenaris' business model as well as its balance sheet. The second company we would like to highlight is a company named Heidelberg, a global cement producer based out of Germany. This is another company that has a successful record of navigating downturns by managing its costs and capital expenditures. The company has also done a decent job of de-levering its balance sheet over the past decade or so. This is visible in the next chart, which shows you the company's net debt, the company's debt to capital ratio from 2007 until present. Heidelberg was also recently able to raise a euro 650 million bond with a 4.5-year maturity at an attractive coupon of 2.5%. This highlights that the company has access to capital markets even in very difficult market conditions.